Welcome back to Jacksonville's Retirement Coach, the podcast hosted by Adam Wolf, the president, CPA, and CFP of Wolf Retirement Navigation there out of Jacksonville, Florida. Get that free portfolio analysis with Adam and the team today. Don't wait. It's the end of the year. You really don't want to wait at wolfretirement.com. And Adam and the team wants you to plan and build a lifelong partnership. Adam, so great to have you on here after a big Thanksgiving. How you doing, sir?
I'm doing outstanding. How you doing?
I'm doing well, thank you. It's good to talk to you today. And on one of the previous episodes, in the last two, we talked about the U.S. retirement grade and how that could be arbitrary, or maybe you shouldn't freak out over that, but also some things to look out for. And we also talked about year-end tax planning. I know taxes are a big part of your practice there. Today, we're going to dig into just what some of the different retirement levers are that you could pull, including Roth IRAs. But Adam, in that last episode, the reason I mentioned it is because you and your firm, Wolf Retirement Navigation, are big sponsors of Tony's Turkey Trot, and we have since had Thanksgiving and the Turkey Trot since then, and you had to do a modified version.
I did the modified version. We had a lot of stuff going on with family and some health concerns for my stepdad. But I live about 2.5 miles from the start of the Turkey Trot there in Atlantic Beach. And so I walked up there, got my 2.5 miles in that way, saw over 5,000 racers. This was the max year. It's the number one or the largest 5K in Jacksonville now. Megan and her team at UF Health, who put this thing on and coordinated it and ran it, they did a great job. First Place Sports did a wonderful job. And it was a lot of excitement, and it was a lot of people up early and a lot of people filling up with coffee before the 5K. They had 3 phases, or 3 waves. They had the fast folks and the medium folks and the slower folks, but everybody had a great time. People were dressed up and lots of excitement in the air. So this is the first year in a while I had not run it. But I had to get back to the house because of the family concerns. So, but I had 2.5 miles walk up there and 2.5 miles back, so I got in more mileage than I would have if I did the Turkey Trot. So, but hey, I'll be ready to go next year.
and it raises money for a great cause there for
Yes.
Tony, right? So
let's see, the Turkey Trot, we raise money for traumatic brain injury. So I just want to thank all my clients and friends who help sponsor and support this, and the racers that came out for that. But traumatic brain injury for not only children but adults. And Brooks Rehab is, the recipient of most of the funds for raising the money and obviously raising the awareness, because it's a big deal and folks need a lot of help with it.
Who would have thought that Jacksonville's largest 5K would be on Thanksgiving morning there, but maybe rightfully so. And I'm glad you got to participate in a different way this year, Adam. And it's really great that Wolf Retirement Navigation helps sponsor this thing and helps put it on. So let's pivot right into the topic du jour. And today it's Roth IRAs. And before we even define what exactly those are and what makes them different than traditional IRAs, you like to clarify, too, what IRA stands for. We have so many acronyms in this business and in this field that we sometimes forget what all the initials mean.
Yeah, just a technical thing, Doug. It's the tax code is where we get all these rules. So an IRA technically is not an individual retirement account. It's an individual retirement arrangement account. So, but most folks say IRA, and that's what we know it for. And it is an account that we can put money into if we qualify for, based on all the different rules, and it grows your money tax deferred. And if you qualify for it, you can get an upfront tax deduction. But when you're down the road and you want to pull this money out, the money that you pull out is taxable. So in a nutshell, in the most simplistic terms, that's what an IRA is.
And that's what a traditional IRA is. And today, then we go to Roth IRAs, which give you some of the same benefits, but you pay taxes at a different time. So, yeah, can you explain what the differences are and why a Roth IRA could be beneficial, and I guess even any cons about it?
Yeah, sure. So back in the 90s, this Roth IRA was invented and brought to the table to grow money tax-free. And so the government was, and I look back on it, I wasn't there in D.C. at that time, but you think about why they would create this thing to grow tax-free, and they did it, in my opinion, for the following reason. you take after-tax dollars and you put it into the Roth IRA. We'll talk about how to get one here in a minute, but in its most simplistic form, you put the money into the Roth IRA that's already been taxed, whereas with your traditional IRA, you're getting a tax deduction when you put money into it. So the government's like, you know what? Hey, we don't want to give tax deductions. Let's go ahead and tax this money first, but give people the benefit of the following. The following is growing money tax-free over time, and then pulling money out through withdrawals tax-free as well in the future. So there's some caveats to that. We can talk about that in detail, but in the most simplistic term, tax-free money, growing tax-free, and then taking money out tax-free for you to spend if you're married, for your wife to or husband to inherit, and or your beneficiaries to inherit tax-free as well.
Got it. So it's tax-free in the end, and a lot of times that means as this money grows that you're more than likely, unless something freak happens, you're going to end up paying less taxes if you use a Roth IRA versus a traditional IRA. Is that right?
Yeah. I mean, the math is, the thing about the Roth IRA, when you're looking at it from a tax perspective, it's more beneficial, in my opinion, when you are in a higher tax rate in the future when you use this money. And I don't know too many people who don't think that most of us, if not all, are going to be in a higher tax situation in the future. You know, even with government efficiencies, the math just doesn't make sense. The government's going to have to cut expenses and raise taxes to cover the burden that's already been built with the federal debt, the ever-growing federal deficits every year. And so I would rather have, and my clients would rather have, a pot, of tax-free money to pull out versus being taxed on money from IRAs and other traditional forms in the future.
I got you. And so, but one of the things is if you plan on taking in less income per year in the future, right? Let's just say you're making bank right now, but in the future you might actually be a tax bracket or two lower. It would probably be not advised to have all your eggs in the Roth IRA basket then.
Sure, yeah, and that's key to, because everybody's situation is different. Think about when your last working years. That's when most people are making the most amount of money, and so you're in a higher tax bracket. Maybe you're in 22 or 24 or 35 or whatever it is. It may not make sense to get a Roth then. Because when you retire, you may be in a 22 or a 12 at current income tax brackets and current income levels. Now, if the government changes that messes with the calculation there. But I think once you first retire, you're in a lower bracket for most people, the majority of folks I work with, but only for a period of time that's going to be short until the government increases the tax rates.
Gotcha. Okay. So there's definitely no one size fits all. I mean, traditional IRAs wouldn't exist or wouldn't still be used if only Roths made sense there. So What are some reasons then that, what would you recommend? Like, do they need to diversify between qualified money accounts like 401k and traditional IRA versus non-qualified accounts like Roth IRA?
Yeah, sure. Let's talk about the ways to get a Roth first. To clarify that, there's four ways to get a Roth IRA. There's the first way is, and this is no specific order, is if you have a 401k and you're working, and your 401k plan has a Roth 401k component to it. Those are fairly recent. You may want to take advantage of that, but that's how you get a Roth 401k. Now, if you retire, you can either keep it at a Roth 401k or you can roll it into a Roth IRA as well out of that plan. So there's rules there. The second way you can get one is if you contribute to a Roth IRA. Right now, if you're 50 years old, it's up to 50, it's $7,000 a year. If it's over 50, it's $8,000. But you must have wages. You must be working or self-employment income. So that's how you get that. Now, another little caveat there is if you are a spouse of someone who's still working, you can qualify. Even if you have no wages, but your spouse does, you can qualify for a Roth contribution. So there's the first two ways to get a Roth. Now, the next way to get a Roth is if you inherit one. Okay, so you can inherit Roth IRAs now as a beneficiary. And there's rules there, on when you have to take the money out over 10 years. There's some caveats there, but that's another way to get a Roth. Now, the fourth way is the most powerful way to get a Roth, and that is through what's called a conversion. That's when you have a IRA or a tax-deferred employer plan like a 401k or a TSP or anything along those lines. You can convert that IRA to the Roth in any dollar amount you want. It could be $1, it could be the full account balance, but you move it over from the IRA to the Roth. And when you do that, you pay the taxes at your current tax rate. And you never have to pay taxes on it ever again, if playing by the rules. So Those are the four ways to get the Roth.
Yeah, that seems like a tricky thing to try to maneuver on one's own. All right. So if somebody is hearing this, Adam, and they're like, wait, do I even have a Roth IRA? Do I qualify? Yeah, how do I convert? I mean, the conversion one especially, you got to do that the right way or you could end up paying taxes big time, in a way you don't want to. What should they do?
Yeah, they should give us a call. We will provide the calculations because there's a math component to this that we have to look at. We have to say to ourselves, all right, if we have all of this, maybe we have contributed to our 401k and we play by the rules there with the employer match, and now we have these large 401ks that haven't been taxed yet. We need to look and see if it makes sense to protect some of that future money from taxation. And through the conversion planning that we do for clients and the tax efficiency planning that we do, that is how we address this, Doug.
Right, for sure. So they go to wolfretirement.com and you could get a free portfolio analysis, right?
That's right. Yep. You get portfolio analysis, and we also run our tax analysis as well to see how you shape up currently.
And also, too, for people that maybe you're trying to get things in order, and we're hearing this right at the very end of the year, so there's not much time, but you recommend people don't wait either. Don't go after the holidays or something like that, because sometimes there's deadlines you're coming up on that actually need to be done by the 31st December.
Yeah, the conversion, if you do a conversion, you have up until December 31st to do that. Now, if you want to make a contribution to a Roth, there are rules. There are income levels and limitations that you have to consider. And so, but the good news with that is for 2024, you have until April 15th, 2025 to make the contribution, or when you file your tax return, if it's before April 15th. So you have to be careful there as well.
And that's why I need someone like you with over 25 years experience, especially dealing with retirement, to help guide them through. wolfretirement.com. Well, Adam, anything else you want to say about Roth IRAs before we hang up the headphones?
Yeah, I mean, the thing is, if you are, and I get this question a lot, what age should I consider a Roth? I think it should be considered for everyone now. We are in the second lowest tax situation we've ever been as a country. Now, hopefully the taxes stay low for a little bit longer, but every 2 to 4 years there's new Congress, there's a new president, and that will change future taxation, and more than likely down the road it's going to be a lot higher than it is today to pay for the massive bills that our government has.
Yeah, the tax rate generally over time goes up, as does inflation too. So want to brace for that, plan for that by getting your retirement cards in order, including with Roth IRAs. And again, that's wolfretirement.com. Well, Adam, thank you so much for taking some time to explain what that is here. We hear a lot of these terms tossed about in this arena, and we don't spend enough time just settling down on what those are. And I got to tell you, this was a better way to receive that information than just trying to Google it or something on my own.
Well, I'm glad I could help out today, Doug.
It most certainly did. Y'all, be sure to check out past episodes of this. We've done a few now. They're on Apple and Spotify, and also wolfretirement.com. If you know someone that you think needs to hear this, be sure and shoot them the link. It's just so they can get a feel for it. And again, you can get that free portfolio analysis today at wolfretirement.com. He's Adam Wolf. I'm your co-host, Doug Turnbull. Thanks to our producer, Daniel Sallerson, for polishing this thing on up and getting it published. And we'll have another episode of Jacksonville's Retirement Coach coming your way shortly. Thank you so much for listening.
Investment advisory services offered through Coil Capital LLC, a registered investment advisor. Wolf Retirement Navigation LLC and Coil Capital LLC are not affiliated. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Opinions expressed are subject to change without notice and are not intended as investment advice or to predict future performance. Past performance does not guarantee future results. Consult your financial professional before making any investment decision. This information is designed to provide general information on the subjects covered. It is not, however, intended to provide specific legal or tax advice and cannot be used to avoid tax penalties or to promote, market, or recommend any tax plan or arrangement. Please note that Wolf Retirement Navigation LLC and its affiliates do not give legal or tax advice. You are encouraged to consult your tax advisor or attorney. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurer. Any references to protection or benefits or lifetime income generally refer to fixed insurance products. They do not refer in any way to securities or investment advisory products or services. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and not offered by Coil Capital LLC. Florida Insurance License Number W016816.